Hey everybody, Brian Shannon here from AlphaTrends.net. Today is Sunday. It's the 2nd of December 2018, and we had a pretty good upside bounce in this market this past week. These numbers, close to 5% for the SPY, 6% for the semiconductors and the NASDAQ. Of course, oil continues lower, bringing its year-to-date down 11% after what's been a horrible month for oil, down 22%. Good from a consumer standpoint, of course. And volatility would lose ground as it did in this rally environment. So let's start actually not with the daily chart, but a candle, each candle that is constructed of 2 days worth of data. The reason I'm choosing to use a 2-day chart is just to get us back to this data here, and we can see the significance of a volume weighted average price from February of 17, which I've noted over the last year. And mysteriously, for some reason, the buyers keep showing up at that level. We saw it first over here in the summer of 17, and then earlier this year, the sell-offs were halted there. And this year, this last month and a half, that is, on this decline, we've seen that area, for some strange reason, is where these buyers continue to show up, and not only show up, but show up aggressively and lead to the rallies like we've just seen. So over to the 1-day chart, meaning each candle represents 1 day worth of trading in the S&P 500. You can see we've closed this black moving average is a 200-day moving average. The green is the 50, and we see, of course, they're still declining, and we're halted right there. So as we noted on the way down, this was not a place to sell short. So now we look at this and say, is this the place to buy, or is it too late if you didn't participate in this upside bounce? Well, you have to ask yourself, where has the market come from? It's just come from 263 and change and rallied basically 12 points up to a 200-day moving average. The 200-day moving average and the 50-day moving average are declining. This area will often, not always, but often act as resistance. So if this is a potential area for resistance after a rally of the magnitude we've just seen, would it be smart to continue to be a buyer in here? Well, it depends on your time frame. If you're a short-term trader, then perhaps this is something that interests you. What we would want to keep an eye on, I think, are the volume weighted average price from the recent move, and you could either measure it from there, or from this day, or maybe even more accurately from the volume weighted average price since the Fed. I think from this gap higher is appropriate to measure risk against in the intermediate term, meaning that we have a rising 5-day moving average, and that's where the buyers had actually taken control later in the day on Tuesday, and then with that gap higher on the Fed day, it did follow through and make higher highs and higher lows above that rising 5-day moving average. So we look at it and say we have a nice stair-step pattern higher with higher lows, that is, higher highs and higher lows down here. So if you bought just recently into this, I think you really want to protect yourself, maybe with a stop below this low here. That also gives you protection basically for the volume weighted average price from the event, or maybe you want to keep it a little bit lower. I think that when you get these sharp rallies in an overall declining market, and that's what it is until proven otherwise, that you want to be tighter with your stops and not allow them to turn into giving back a large percentage of those gains. So I think that this coming week we're likely to see that this market slows down in this area. I'm not the type of person who looks at this market and says, hey, I'm expecting another large decline. Instead, I think that if it maybe continues to trickle higher, even up slightly through that 50-day moving average, and then kind of settle down in here, well, I think that's the best way for this market to move forward, so that maybe it does have the potential to see a true Christmas rally into the month of December. The NASDAQ also, I'd said that you don't want to short these declines. It wasn't quite ready to buy yet. If we look at the longer term, it pretty much came down pretty much on that year to date, the volume weighted average price from the election, halted just a little bit above it. But then the buyers regained control in here, of course, as well. And now we see maybe this market has the potential to continue up towards 172, 173. On Tuesday, I said, I think it's too late to, on Tuesday on the Yahoo show, that is, I said, you don't want to short in here. Maybe it can bounce, and if it does, up towards 170. We're in that 170 area. It doesn't mean short there, it's a potential level of resistance. We might have enough energy to continue up towards 173, 172, somewhere in there, and then maybe pull back and see if it can continue to build for bullish upside for the rest of the year. But again, in this market, we're getting a little bit extended. This is basically the month of November that we're looking at here on this chart. We've got a volume weighted average price off of that November peak and off of that November low, and you can see the VWAP from the peak is up right at the 5-day moving average. So I think the more important level we're going to want to see hold is down near 166 if this market begins to pull back. And again, it might continue up higher first, maybe a sharp sell-off down towards there, and if that holds, then it could rebuild. Looking at a 65-minute time frame, it's looking a lot better. The Russell 2000, I think this market maybe has the best potential for further upside. You can see that the volume weighted average price from the election has been acting as a place where buyers have shown up for this market repeatedly in the last 2 years, and we're getting a bounce from there once again. Now, of course, it's still a rally within an overall downtrend, but we saw a bounce, a higher low, and maybe we see another lower high, and perhaps the Russell continue up towards 156-ish. If you're looking to participate in such a trade, well, again, let's look at the range for November. We're above the volume weighted average price from this prior low here and this peak and from this low, and now you can see that these two volume weighted average price levels, that is from the late October low to the November high, are kind of tied right in here with the 5-day moving average, and this market is hanging just underneath a little bit of what's been a band of resistance. What we often see happen is, it'll rally up through that level, come back down, shake people out, rebuild, and then get going. So that would be the preferred way to see this market rally. If it continues to move higher, and if you're long, I think at this point your stop goes underneath this little shakeout low, which is also where we see that we would have protection from that rising 5-day moving average. So the Russell, continue, I think, to see some bounce mode in this market, but it is still in a primary downtrend. We don't trust rallies with a declining 50-day moving average, so you use that information for your position sizing. If you have what you feel is a lower probability overall of success, then you lower your share size. But if you say, well, I still want to participate in what might be, then again, the job of a trader is to measure whether the trade makes sense to them for their time frame once they've considered the potential risk and reward in that market. The semiconductors rallied up close to the declining 50-day moving average, and this market here on a 30-minute time frame, this is what I had outlined, I think, earlier in the week, and it's kind of doing what would be a the bullish scenario for this market, which is to create maybe what's looking like an inverted head and shoulders pattern. Of course, this being the left head, the left shoulder, this being the head, and this being the right shoulder. The daily time frame, still a mess, still difficult to trust. It's right at a declining 50-day moving average. So again, with mixed messages, you might be seduced by these large moves and say, oh, I coulda, woulda, shoulda done this or that, but you have to consider the alternative when they move against you. The best thing to do is to avoid, being the guy who sells short at the bottom of the range and buying at the top of the range. So you have to look at that. This volume weighted average price from the election had been support previously, and it's now finding that resistance. Sellers are showing up in this area, and again, that's right where we see the declining 50-day moving average. If it's to continue back higher, maybe somehow it gets up beyond 100 and into that year-to-date VWAP and 200-day moving average. I think it's not likely, but you have to look at this market and from what it did this past week and say, what's likely, but don't be surprised by anything, because anything is possible. The biotechs are bouncing from that bigger level of support that we have identified. And, as I've said, I wasn't calling this a bullish area to buy. I said it's probably more neutral than anything, but this market is, in fact, finding buyers in there. And if you look at some of the individual biotech names from Amgen to a couple of the other ones, even the Pfizer and Merck are all showing big rallies here. The biotechs, I think I mentioned, I thought they can continue perhaps up towards the conjunction of the 50 and the 200-day moving average, which is also where we find the year-to-date VWAP. So I wouldn't be shorting this market. The buyers are in control from the last week, and this is really kind of, you could say, where this move began. So if you have a long position in these biotechs, I think your stop now goes up underneath this level. That'll do it for me. I hope you had a good week of trading, and thanks for tuning in.